Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about one of the most effective yet straightforward approach to navigating the market, the simple trend trading strategy. Now, this strategy has been a cornerstone for many successful traders, allowing them to capture significant market movements while minimizing complexity. So by focusing on the natural flow of the market, you can enhance your trading skill and improve your chances of success. So stick around with us until the end of this video to learn how you can apply this powerful strategy to your own trading and to discover how it can help you achieve more consistent results in your forex trading. We start by understanding what the trend trading is all about. Trend trading is a strategy that involves analyzing the market movement to identify and follow the direction of the trend, and this is based on the idea of taking the path of least resistance, buying when the market is rising and selling when it is falling. This approach helps traders align their trades with prevailing market momentum, making it easier to navigate complex market conditions. Understanding the trend can be characterized into three main types. If you want to understand the trend, you understand it by an uptrend, a downtrend, and a sideways moving market. This is a typical example of an uptrend when the market is trending to the upside, making series of higher highs and higher lows, and is respecting our trend line to the upside. While a downtrend is when the price is making a series of lower lows, lower highs, and is respecting the trend line to the downside. While a sideways moving market is when the market is moving in a sideways direction without any movement to either the upside or the downside. Now, there are some key tools for trend trading, and the first tool would be your trend line. The trend line, these are lines drawn across significant highs and lows to visualize the trend of the market, to visualize the trend direction and the trend strength. So using trend line as we used in this area, we can see that it visualizes that we are trending to the upside. So with this trend line, you can be able to know what the market is doing. The second way we can use, or the second tool we can use for trend trading, is our moving average. Your moving average can also help to confirm trend by acting as dynamic support and resistance on the chart. And as we can see, the way price are respecting these moving averages to the upside, signaling that they can help us act as dynamic support and resistance, in this case support on our chart. Now, the third tool would be our chart pattern, and this involves formations of higher highs and higher lows in the market. And as we can see in this area, this is a higher high, a higher low, a higher high, a higher low, a higher high, higher low, a higher high, a higher low, and a higher high. This is another key tool we can use to identify our market direction. So let's look at a simple trend trading strategy that is designed to help us capture significant market moves by aligning our trade with the prevailing trend. This is straightforward, but it is very effective, and it can be applied to any time frame throughout your chart, and it works particularly well on your daily chart, your 4-hour chart. So we start by explaining this strategy in a step-by-step way. The first step would be to identify your trend direction. The first step is to identify or determine if the market is in an uptrend, downtrend, or a ranging phase. And as we can see from this trend line, we can see the market is in an uptrend. We have to look for series of higher highs and higher lows to confirm an uptrend in this market, and as we can see, it's creating series of higher highs, higher lows, higher highs, higher lows, higher highs and higher lows in this market. While in a bearish market, you see a series of lower lows, lower high, lower lows, lower high, a lower low and a lower high. This would help us to understand if price is oscillating around a clear support and resistance level without making a new high and low. It's likely to be in a ranging market when price is oscillating between support region. Like in this area, if you can look within this area, when price is oscillating within this region, you can see that it's in a range bound market. The second step will be to draw your trend line. After identifying your trend, you will draw your trend line, which has been drawn on my chart on this uptrend. Once you have identified your trend, you draw your trend line to visualize the trend strength and direction. For an uptrend, you draw it by connecting the series of higher lows. For your downtrend, you will draw it by connecting the series of your lower highs. The trend line is considered valid if it has been touched by price at least 2 to 3 times. As you can see, it has been touched by price 1, 2, 3, so it is considered valid. The third step is to wait for a pullback. The key to this strategy is patience. After you have noticed that price have retested your trend line 3 times, you wait for price to come pull back to this trend line to respect that area. This is in a buy scenario. You wait for price to pull back to this trend line. When price pulls back to this trend line, you can look for your candlestick pattern at this trend line to further confirm your entry signal before you enter your position. Remember to always wait for the candle to close in your favor before planning your trade. As you can see, when price came to this area, it gave us a hammer candlestick pattern, a doji and an engulfing bullish candle. An engulfing candle would be the confirmation for me to enter my long position on this trade and would aim for our next resistance region on the market. What you need to do on your step 4 would be to execute your trade. Once price has pulled back to your trend line or to your moving average, as the case may be, if we add our moving average, you can see price pulled back to the moving average at this area. This is our step 4. Once we have seen a pullback, we look out for our engulfing pattern, which is what we saw at this area, and this will be our signal to enter our position. In terms of a selling position, after price have respected your trend line 1, 2, 3 times, the fourth time when price came to the area, you can wait for price to give you your bearish signal, like your bearish engulfing candlestick pattern. You enter your trade, you execute your trade at that area, and you will place your stop loss. Managing our trade is very important. You have to place your stop loss just above the recent swing high, or in a selling trade, you just place it above the recent swing high. In a buying trade, you place it below the most recent swing low. You can also make use of your ATR to set your stop loss. In a selling scenario, you just need to, if you are making use of your ATR, you just need to get the area where you entered in alignment with your ATR value, and you add them together to get a stop loss for that trade. Or you can stick to setting your stop loss at a recent swing high, because you know that when price gets to that area, it invalidates your trading setup. Your step 6 is to manage your trade by setting take profit targets. You can also use a take profit target of 1:2 or 1:3, as the case may be. You can also take profit at your nearest resistance or support region. You can take profit in the next swing low. In this trend, in this trade, you can see that price was making a series of higher highs and higher lows. You can take your profit in the next, at the previous higher high region where you expect price to take out. In the selling trade, you can set your take profit target at the next swing lower low price is about to take out. You can also decide to make use of trading stop loss to capitalize on more gains when the trade moves in your favor. You can also take partial profit at a risk to reward of 1:1 and you allow the rest to run in profit. Step 7 is to always manage your risks. Never risk more than 1 to 2% of your trading account on any single trade. Remember this. This will avoid trading against this will avoid you trading against what you can afford to risk. Meaning that if you have a $5,000 account, you are permitted to only lose at least 1 to 2%, which is $50 or $100 maximum on your trading capital. This will ensure that you are in the game for a longer period of time. In case there is a series of losing trades, you can always come back and capitalize on the market and regain back yourself. That's why we also advise you to use a good risk to reward, so that even if you take a series of 2 losses in a row, whenever you take a risk to reward of 1:2, 1:3, you can immediately cover up your losses in the market. Always avoid trading against the trend. Once you notice that the market is not in line with your trend line or the direction you have anticipated the market to be in, do not decide to take a counter trend, because you can be easily swept out of the market. Always skip setup when you find out the trend line is too steep. When you see a setup with a steep trend line, you avoid taking such trade, as these are one of the most likely trades that the trend line will break. Price will break through the trend line. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.